Robert Kiyosaki drew a simple diagram in 1998. Only 4 boxes: E, S, B, I. Employee, self-employed, business owner, and investor. He said the left side, E and S, trade time for money. You work, you get paid. You stop working, the money stops. But on the right side, B and I make money while you sleep. Their assets work. They don't have to. I want to show you this diagram because it's the reason I started investing in real estate in 2016. I was a software engineer. I had a stable job earning a good salary. But I was on the left side of that quadrant. Every dollar I had came from hours I traded. And I realized if I stopped showing up, everything stopped. The quadrant isn't just a diagram. It's a map of how money actually works. Left side, your money has a ceiling because your time has a ceiling. You only have 24 hours per day. But on the right side, your income scales because assets don't clock out. Real estate is the bridge between those two sides. It's the most accessible way a regular person moves from E to I. I started with $30,000 and no real estate background. Today, I own 22 properties worth $5 million with $404,000 per year gross rental income. It generates income every month whether I work or not. So in this video, I'll break down exactly how I implemented Robert Kiyosaki's strategy as a complete beginner and how the same strategy made his $1 billion fortune. Let's talk about the asset trap. There's a story in Rich Dad Poor Dad that changed the way how I think about money. Kiyosaki had 2 father figures growing up. His biological father, educated, well paid, always broke. But his friend's father, no college degree, quietly building wealth. One day, Poor Dad pointed at his house and said, "That's my biggest asset." Rich Dad looked at him and said, "No, that's a liability." Poor Dad couldn't understand it. He had paid into the house for years. It had gone up in value, but the Rich Dad pulled out a piece of paper and drew 2 columns. Assets, things that put money in your pocket. In the other column, liabilities, things that take money out from your pocket. Then he asked, every month, does your house put money in your pocket or take it out? Mortgage, property tax, insurance, maintenance, every month money flows out. That's not an asset. That's a liability wearing an asset clothes. The reason this matters is because of what it does to your financial position over time. If everything you own is taking money out, your house, your car, your savings account sitting at 0.5%, you are building a life that costs more every year without generating anything back. But the asset column stays empty. The liability column keeps growing. And the gap between where you are and where you want to be gets wider, not narrower. I use the same strategy to build my portfolio of single family homes. Before adding any new property to my portfolio, the only question I asked myself, will this property make money each month or do I need to spend from my pocket? This simple test helped me avoid all the appreciation hype and the focus on what matters most, cash flow. Let's talk about the $1.2 billion lesson. A few years ago, Kiyosaki sat down on a podcast called the Iced Coffee Hour. The host asked him a straightforward question. How much debt do you have? Kiyosaki didn't pause, didn't even flinch. He said,
1 billion too.
1.2 billion. The host face said everything. I want to show you what Kiyosaki said next because it's the thing that unlocks the whole strategy. He said, my tenants pay it off. The bank lends him money. He buys a property. A tenant moves in and pays rent. That rent covers the mortgage and leaves something over. He called it OPM, other people's money. That means the bank's money, the tenant's money, working together to build his wealth. He wrote in his Rich Dad's Guide to Investing, the rich don't work for money. They have their money work for them. And the best way to do that is with other people's money. But before you take on any debt for a property, run Kiyosaki's 3-question test. Does the rental income cover the mortgage with cash left over? If the deal only works when everything goes perfectly, it's too fragile. Can you survive 3 to 6 months of vacancy? And and still make the payment? If the answer is no, you are over leveraged. Does the property build both equity and cash flow at the same time? If yes to all three, the debt is working for you, not against you. I always used a 30 years fixed conventional or DSCR mortgage to fund my investment property with 20% down. That was my go-to strategy to buy investment property. You can get 10 conventional mortgages per social security number in the USA. Then you should consider moving to DSCR based loan, which means debt service coverage ratio. Let's move on to the next thing, the qualification game. Before the bank hands you OPM, you have to prove you deserve it. And the way the bank measures that comes down to only two numbers: your credit score and your debt to income ratio, which is also called DTI. These aren't obstacles. They are the entry requirements to the game. Get them right and the bank becomes your business partner. Get them wrong and none of the rest of this matters. I have applied close to 35 mortgages over 8 years, worked with 20 different lenders. I have been approved for all but one, and that one failed because the appraisal came in low, not because of my numbers. I have spent enough time inside Fannie Mae's guidelines that I have corrected loan officers who got them wrong. And what I have learned is that most people fail to qualify not because they can't, but because they don't know what the bank is actually looking for. So here's how it works. Credit score 580 is the floor for an FHA loan, but 720 or above gets you the best rate, and over a 30-year mortgage, that difference is tens of thousands of dollars. Debt to income ratio, the bank adds up all of your monthly debt payments and divide by your gross monthly income. Most lenders want that number to be under 43%. So if you earn $10,000 a month, your total monthly debt payments, including the new mortgage, need to stay under $4,300 per month. Those two numbers are what the underwriter looks at first. To get your credit score up, pay every bill on time, knock down credit card balances below 30% of your limit, and dispute any errors on your report. I took my credit score from 580 to 780, doing exactly those three things. To get your DTI down, pay off smaller debt first. Avoid taking on new loans before you apply, and don't make large unexplained deposits into your bank account during the application window. Then go to at least 3 different lenders and compare. Different lenders have different DTI threshold. I have been approved at DTI of 50.5 with the right lender. Shop in a 40-day window and all the hard credit inquiries count as one. Let's talk about the deal filter. Once you are approved, the next problem is finding the property that actually works. And this is where most beginners slow down because they spend weeks on a single deal, running numbers, second guessing, going back and forth to make the deal work. Kiyosaki has said it repeatedly in interviews and on YouTube. Don't invest for appreciation. Invest for cash flow. Cash flow is the king. The question isn't whether the property will go up in value. The question is whether it pays you every month. Here's the 2-stage filter I use across my 22 property portfolio. Stage 1, the 1% rule. Take the purchase price and multiply by 1%. That's the minimum monthly rent the property needs to generate. $100,000 property needs at least $1,000 per month in rent. $150,000 property needs at least $1,500 per month. If the numbers don't hit 1%, I move on without doing any more analysis. Stage 2, the 50% rule. Take the gross monthly rent and cut it in half. That half covers taxes, insurance, vacancy, repairs, and property management. Whatever left is your net operating income. Subtract the mortgage payment. If what remains is less than $200 per door, the property faces the screen. This 2-stage filter means I can evaluate 20 properties in the time it takes someone else to agonize over one. 2 more things that matter before you buy. Location. Buy in landlord-friendly states: Texas, Florida, Alabama, Arizona, Indiana, or even Tennessee. In these states, if a tenant stops paying, you can start the eviction process in 3 to 7 days. In tenant-friendly states, that same process can take 12 to 18 months. That's 12 to 18 months of carrying getting a mortgage with no rent coming in. What about the property type? I only focus on single family homes in working class neighborhoods because it has its own advantage. One family to rent to, easier to finance, easier to sell if you ever need to. Tenants stay longer. That's the profile that builds this portfolio. The compounding loop. In 2017, I bought my first rental property in Seattle. After all the expenses, it made $300 a month. That felt small, but it wasn't the $300 that mattered. It was what that $300 represented, a system that could be repeated. Kiyosaki describes it on the Rich Dad radio show as buy it, fix it, rent it, refinance it, and repeat. That's the loop, and the loop is what turns one property into 22. Here's how the loop actually played out for me. 2017, first rental, Seattle, $300 cash flow per month. 2018, I used a HELOC on my primary residence plus a signing bonus to buy a second rental in Redmond, $200 a month. 2019, 6 personal rentals, cash flow reinvested into the next deal. 2020, interest rates dropped below 3% during the pandemic. I refinanced 4 properties, monthly payments dropped, cash flow went up. 2021, I sold my primary residence, $550,000 purchase, $1,050,000 sale, zero capital gains tax because it was my primary home. Used a 1031 exchange on a Seattle rental to roll the proceeds into 6 properties across Alabama and Nebraska. At that time, I had total 11 rentals. I already achieved financial independence. Today, the portfolio has 22 properties worth a $5 million portfolio, and the whole thing takes me only an hour a week to run. Here's why the loop compounds the way it does. When you hold a property long term, 4 things happen at the same time. Your tenants pay down your mortgage balance every single month, building equity you didn't have to earn. Rents rise with inflation while your fixed rate mortgage stays constant. So your cash flow expands automatically every few years without any action on your part. The property value appreciates across market cycles, and when you eventually sell, a 1031 exchange lets you roll the gain into a larger deal without triggering capital gains tax. All these 4 engines running simultaneously, none of them require you to show up. The practical steps to start the loop. Step 1, FHA loan, 3.5% down, buy a property with a basement or extra unit. Live in it, rent part of it, your tenant covers a portion of your mortgage. You save the difference. Step 2, after 1 year, move out, rent the whole property, repeat with the next one. Step 3, once you have the equity, use a cash out refinance or BRRRR to recycle your capital into the next deal without starting from zero. Step 4, hold everything. Don't sell. Don't time the market. Keep 6 months of mortgage reserves in cash so nothing forces your hand. The loop doesn't require speed. It requires consistency. One property at a time, 1 year at a time. That's how $30,000 becomes a $5 million portfolio. You now understand the full framework, the quadrant, the asset trap, the debt strategy, the qualification game, the deal filter, and the loop that scales it. The next question is, once your properties start generating consistent cash flow, how do you invest that income to grow your net worth even faster? That's exactly what I teach inside my entrepreneurship mastermind. The link is in the description below if you are interested in building your true wealth in the next 5 years.